increased market volatility right now, it's easy to miss the bigger picture. But with a new year, it's a good time to take stock of your entire portfolio and your investment goals. To help do that, let's take a step back and get an idea of what Canadian investors can expect from asset class returns in the longer term. Here with this forecast is Derek Bolton, Deputy Chief Economist, TD Bank Group. Hello, Derek. So what do you see out there? What would you say is the largest impact if you're looking at medium to longer term horizon?
Yeah, by long term, we're talking about 10 years, so certainly a fairly lengthy period. When you talk about a period that long, you're talking about some of the basic fundamentals of growth in income, things like demographics. You're talking about inflation. Overall GDP growth. Those are key drivers over the long run. But no doubt over the next 4 or 5 years, what will influence those returns are higher short-term interest rates. We're at a period in the cycle now. The Fed is signaling that it's going to take rates back to more normal levels, and taking away that proverbial punch bowl is certainly going to impact returns for at least a half of the 10-year horizon. So we tackle both of those in our recent forecast.
Now, what about if we take a step and look at Canadian equities? Where do you see that going?
Well, actually, we're fairly upbeat on Canadian equities. I mean, you look at the past 10 years has not been great for Canadian equities. S&P TSX has gained about 4.5% on average per year, quite a bit less than its American counterpart. A lot of that in recent years has been the story of falling commodity prices just badly beating up returns. So we do see upside. I mean, premised within this would be the view that commodity prices will begin to grind higher. It's not really a near-term story, I think, but as we get out into sort of the next 3 to 4 years, we'll see better commodities. I think that'll help Canadian equities at least outperform. We've got the view the Canadian dollar is going to remain quite low on average, and that provides a bit of a fill-up to income growth for many Canadian companies that have U.S. holdings or holdings around the world. So that's another key feature there. So on average, we're looking at Canadian equities deliver about 6.5% per year over the next 4 years, which is quite good.
And how does that compare to the U.S.?
U.S. not so upbeat. We'd see about a 2% annual average return over the next 4 years. The near term, we'll see. I mean, there's just a lot of volatility, as you mentioned, but clearly some indications of the market's fairly richly valued, hasn't been beaten up as much, and has less upside potential. It doesn't mean the U.S. economy isn't going to do well. That's going to provide underlying support. But I think just the fact you do have less upside, a strong U.S. dollar is going to clip the wings of the profits of a lot of American-based companies, and it's going to lead to a period of relative underperformance after the very positive run we've had in the last decade.
All right, interesting. Now what about bonds?
Bonds, no doubt will be driven in part by the trends in the short-term rates. The Fed is likely to raise rates, but very slowly. I think that's key here. It's going to take that punch bowl away very slowly, given some of the vulnerabilities in the economy, the low inflation. So we see about 3/4 of a point in short-term rate hikes per year over the next few years, taking the short rate back up to around 3.5%. So, that's going to put a bit of a damper on bond yields. They've had quite a run in the last decade. But with that kind of short-term rate profile, it's going to lower prices of bonds. You'll get a coupon, but it'll more or less offset each other. So that's going to be a challenge facing bonds. I will say one thing in support of bonds is that with the world still awash in liquidity, and at least over the next few years, you're still going to see fairly healthy demand for longer-term bonds in particular, as the ECB continues to, print money, Bank of Japan as well. So that's going to support bond prices, and which would mitigate the risk of a deeper fall in returns.
What about governments versus corporates?
Yeah, we do see corporate spread products doing a bit better than governments overall. Again, key within that is the fact the Federal Reserve Bank of Canada, and that will eventually begin to tighten rates. That's a very slow process. We see spreads quite wide to start the period, so we don't build into the next 4 to 6, 10 years a major change in spreads relative to risk-free governments. So I think that helps mitigate some of the downside. So they'll eke out a small gain, but not very much. Certainly the rate of inflation, I think you'd be lucky over the next 4 years. And then beyond that, you get back to more normal period returns, about 3.5%, 4% a year in fixed income.
All right. And last but not least, cash.
Cash is going to be the losing area. You know, rates will come up, but very slowly. You know, it's a sort of a story where you might eke out 1% returns. In Canada, in particular, with the Bank of Canada not raising rates until the tail end of 2017, and may in fact even cut. Very negligible returns for cash. So that's going to be probably the worst performing, along with governments, over the next four years or so.
Just wanted to take a step back. How do you come up with your forecast? What are sort of some of the components that go into it?
Oh, there's a lot of rocket science,
yes.
But it comes down, we look at it very, very much from an economic lens. And I think when you go out longer term, you can do that. I mean, the past has shown that things gravitate towards some of these underlying fundamentals. So we have baseline views on things like what's Canadian corporate profit growth tied with the growth in the economy, the growth of trading partners Canada deals with, our view on short-term rates, and we bring it all together, have a view on dividend yields and that kind of thing. So we pull it all together in this long-term forecast.
All right. Well, thank you very much, Derek.
Thank you.
And all the information on long-term returns is available in the TD Economic Report at td.com/economics. I've been speaking with Derek Bolton, Deputy Chief Economist at TD Bank. I'm Marianne Deveni. Thanks for watching.